Okay, so let's get started. I think we're doing this after some time. The last time we did this was when we were discussing the multi-bagger mindset. So it's been a while. Uh, the intention is always to have more frequent interactions, but somehow it keeps sort of getting postponed. So today, I think Hitesh Bhai actually mentioned that let's do it. So that's why I think we discussed this over the weekend, and we didn't have a lot of time before sharing it out with you. So apologies for the short notice, and we didn't want to wait for a long period also before we started. Just mandatory disclosures because we're recording this for future use. Whatever we discuss, see, essentially, we will try and not discuss individual stocks. Uh, many reasons for it. I'll come to that later. But the idea is, even if we do discuss a few names here and there, uh, those would be more as examples, not any kind of recommendations to buy or sell. Uh, Anything that we discuss about stocks, please, you know, take it with a pinch of salt. We're all people who are invested in the markets. Uh, I am actively a participant of research service as well as a PMS. So uh, I have vested interests. So just take whatever we discuss in terms of stock pickings with do your own due diligence first. So with that, I just before handing it over to Hitesh Bhai for him to start off, uh, I think all of you, at least people who've joined, would know Hitesh Bhai and me. Just but for those who may be joining in for the first time, I'll just take a minute to introduce. Uh, Hitesh Bhai is a doctor by profession, dermatologist. He still practices, but I think primarily now he's a investor by time and effort spent. Uh, he's a brilliant techno funda investor. A lot of you would have seen his thread on Value Picker even earlier. Now it seems odd. 15 years back when there was TED, the equity desk, even then he used to be sharing his thoughts, and he's very candid. He's very active in terms of sharing his ideas, his thoughts, his learnings. And I've personally had the privilege of learning from him over the last 10, 12 years. And my name is Abhishek Basu Malik. I have also been investing for a long time. I do, we run IntelSense. I've started IntelSense after I left my job, and I also manage a couple of funds in the Sri Rama Managers PMS. So with that, let's get started. I think Hitesh Bhai, you can start off.
So, good evening, everyone, and thanks for taking out the time to attend this webinar. So, is my voice clear to you, Abhishek?
Yeah, absolutely. Yeah.
Yeah. So, basically, this at the time of this webinar, we are in the midst of this election mania that's been going on, and there are a few observations which I would like to start off with relation to the election year history that has happened in the recent past. So ever since say the BJP came to power, so that this is the third election in a row, and just to get you up to date with what has happened in the past in terms of what impact elections have had on the market and why it is so. So that is what I want to basically start off with. And this time, what we have done is we have tried to keep our presentation short and try to keep more time for question and answers. And as Abhishek said, most likely we will not be discussing specific stocks, but if at all we end up discussing that, please don't consider that as a recommendation. So that is basically a disclosure that I'd like to make at the beginning of the presentation. So coming to 2014, so we had the major election, which is a kind of watershed moment in recent Indian political history. So the element of surprise was there when PM Modi came with a very stable government and a clear majority. Whereas all the recent past governments were coalition governments where they had to take support of this or that party. But in 2014, he had a clear mandate, and so there was a confidence in the market that probably because he was being viewed as a futuristic person at that point of time because of his track record in Gujarat. So markets were excited about welcoming him to the PM's office. So in the run up to the election, Nifty had already run up from the levels of say 6,000 in February 2014 to 7,600 in June when the results were expected. And this rally continued to the levels of 9,000 plus till March 2015. So that is uh, around 8 to 10 months after the election results were posted, the rally continued. So that was the kind of euphoria that that particular election results generated in the market. And I feel that was mainly because there was a huge element of surprise, even though people were expecting BJP to say win the election, but nobody expected a clear mandate. So that was the element of surprise that we had at that point of time. So whenever there is a positive surprise, markets tend to react positively, at least for some time. And after that, fundamentals and macro factors take over. So this statement applies even to specifically to stocks as well, because any kind of positive surprise and you can see big up moves in stocks. Next, we come to 2019 election. Abhishek, the slide is not very clear. So in 2019, the BJP was expected to win the, yeah, now it is clear. So BJP was expected to win comfortably, and in those expectations, the market had already rallied to a then high of 12,000 levels. And post-election also, because there was not much element of surprise, the Nifty remained range bound between 10,600 to 12,200. In fact, post-election, there was a sort of dip also. So that was because, as said earlier, there was not much surprise in terms of number of seats BJP won. Everybody expected BJP to win comfortably and have a complete majority. But after that, what happened was the big drop that you see is COVID-related meltdown, where the indices went down to 7,500 levels post the above range bound moves. But this was a one-off event, and this should not be correlated with your election history and the market correlation, because we all know it was once in a while kind of event that happened. And now coming to 2024, the current situation where we are. So since 2020 COVID lows, we have had a very strong rally for nearly 4 years now. And index is, after brief corrections here and there, index is quoting it very close to the all-time high of 22,700. We are, I think, at around 22,400 kind of levels, not much below the all-time highs. So during all these last few months, indices have brushed aside all kinds of concerns of war, crude prices, geopolitical risks, and BJP winning comfortably is, I think, baked into the index numbers. So there is very little space for any nasty surprises. Not saying that uh, results wise any nasty surprise is going to come. Only thing is there's a huge build-up about up ki bar 400 par kind of thing, and people expect a lot of constitutional changes that can happen if they get more than two-thirds majority, that kind of a thing. But that is something that we'll need to see how it goes. But um, my contention is that going ahead into the elections, it's always better to remain light, say after around 15-20 of May till the time the actual results are declared, so early June. So
4th
uh,
June.
normally I don't take any uh, timing kind of thing for the markets, but this is a very event specific thing. And say even if after that the markets continue to run up, we can always change our stance and get right back into the market, because as we have seen since a long time of our association with Hitpix and Abhishek's all other advisories also, there are always specific picks available at specific point of time in the market, and there is often sector rotation going on continuously in the market. So there'll never be shortage of opportunity in the market in terms of stocks to invest. Uh, After all, it's an individual call whether to get into slight amount of cash or not. That is all dependent upon the individual person. This is the thought process that I have. As of now, I am also fully invested, and I am not very sure I'll be able to get into cash also, because in the past I haven't had too much cash in my style. So let's see how it goes. But basically, this is a hypothesis that I have, and it's better to go with a plan rather than go totally without a plan into such a big event. So that is, I think, my brief presentation. I think Abhishek can take over from here.
Okay, thank you. Thanks, Hitesh bhai. Can you hear me, right?
Yeah, I can hear.
Okay. So, guys, I thought I'll just give you a very brief overview of what I was thinking. Pretty much like what Hitesh bhai did. So broadly, I'll take you sort of uh, like uh, from the top down. So what we are looking at all across, right? What we are just 1 second. Let me see if just give me a second. I don't know if are you guys able to see me when I'm speaking or no? If somebody can mention that.
Yes, sir.
Yeah, we can see
Yeah,
you.
we
We can see
can.
the presentation also.
Oh, okay, perfect. Thank you, thank you. So then, wait. Okay. So first thing is in the last month or so, we've seen multiple global agencies, whether it is S&P, whether it is the IMF, or whether it is Fitch. They've come up with upgrades for Indian growth, GDP growth for FY25. So previously, everyone had put it at somewhere around 6.3 to 6.5%. People have now upgraded it to roughly 6.8 to 7%. The other interesting part is we are expected to be roughly double of the global average, right? Which is a big thing. And India is supposed to be the biggest beneficiary. Uh, not the beneficiary, but the biggest driver of growth for uh, the global, economy. The other important thing is if I look at flows into Asian markets, what is very evident is that China has been a major, people have taken out money significantly, and one is people have taken out money, and the second is they've not invested in China incrementally, and uh, the flow has moved to uh, Japan, China, South Korea primarily. So these three countries have been the biggest beneficiaries. So that is a very high level view of where we are. Now, if I look at valuations, this is the P ratio for Nifty 50, and if I look at it from say roughly 2006 middle to now, uh, that's about 18 odd years, you'll see that we are roughly at a median range. We are not extremely overvalued. So Nifty 50, if I consider that as a large cap basket, and we are pretty much in the same place when we consider a much broader index. So if I look at a Nifty 500, which is a mix of large cap, mid cap, maybe even some small caps, you will see that again we are not way out of whack in terms of valuations. So that is something which is to me, when people talk about that markets are overvalued and heated up, I don't think that that is essentially true, right? Over the years, and I probably I don't think I've added those slides here, but a large part of this growth in the markets has come from EPS growth, which is the good part, right? Uh, Now, if I break down this into sectoral valuations, you will see that uh, across the sectors, again, we are not very different from uh, what the 10-year average is, both in terms of PE or in terms of price to books. One place I think which sort of, from the data perspective, uh, just stands out is private banks. Private banks is actually now cheaper both in PE and price to book terms over a 10-year average. Right? Others are more or less in the same region. Uh, there are again some pockets like infrastructure, right? We know it's cyclical. So uh, last 7 8 years, 10 9 years have been bad for infrastructure. So the average PE has been low. Now it has picked up. So again, uh, the anomaly is significant. But in general, you will see that it's not uh, very different from what the last decade has been. And in the meantime, what has happened is if you look at the core balance sheets of companies at an aggregate level again, you will see that the ROEs of the companies are improving, right? Post COVID, things are getting better. And
No,
corporate leverage uh,
Allah.
is at 15-year lows. I think somebody is muted. Can't figure out who is.
Darsha.
Somebody who is not muted. Let mute all. Okay. Okay. So I'm assuming that you can hear me. So corporate leverage is also going down. Banks have now become much better. I mean, bank balance sheets are much stronger. If you see, RBI has been much more stringent in terms of talking about some kind of exuberance in retail credit. So, that is again an area where everybody is concentrating, from the regulators to the banks, to ensure that things don't go out of hand like it did in the last cycle. So things, fundamentally look pretty good. And very importantly, I think from global flows perspective, capital flows, the weightage of India is consistently going up over the last 3 4 years, and this is happening at the cost of China, uh, and India is becoming a now uh, to an extent an asset class by itself. So if whenever you talk to, or whenever we read about large global fund houses or pension funds or sovereign funds, they are now starting to look at an India strategy. So it's not only corporates where India gets discussed at the board level in terms of uh, uh, coming and setting up their business or having a strategy for building up their business, but also from the fund management industry. We are seeing that India is now one place where everyone wants to be. So overall, I think we are now in a pretty good place. I personally am very bullish for the next 5 to 10 years. I typically tend to have a long-term view in terms of when I have a portfolio view. I've always maintained that my portfolio is there for the next 30 years, and the constituents of the portfolio will keep changing. But I have a view that India is going to do extremely well for the next 5 to 10 years. So with that, I will stop my question. Pause my presentation here, and let me see the questions. What questions have started coming. So what you can do is you can start putting up your questions. I'll stop sharing my screen so that it becomes easier. And let's start looking at the questions. Okay, so before we get into the questions, I think there was one question that had come in early, which is basically about uh, how do you how do you increase allocation beyond, say, 10-15%. So somebody wants to ask this question, that they want to add stocks, say, to 20% based on their conviction. So how do you do that? So I'll pass this question on to Hitesh bhai, because because my answer will be completely different. So first I'll let him answer, then I'll maybe share my thoughts. So Hitesh bhai, you need to unmute yourself first.
Okay, done.
Yeah,
Now audible?
yeah.
Okay, so scaling up a position basically, see, first is it will also boil down to what kind of an investor you are. So, if you are a diversified investor, you will find a lot of difficulty in going beyond, say, 10-15% in terms of allocation to a particular stock. So, that is a basic trait of an investor, and nothing can be done about it. But for most investors, retail investors, I think most of them do end up having 10 to 15 stocks after certain amount of time in the markets, if at all they are going in the direction of concentrated investing. So we will be basically whatever I am answering is for those investors who have the mindset to take concentrated bets. For those who don't have that mindset, I think this won't work. Or if at all it will work sometimes, not all times. So for those who are ready to take the big bet and have the mindset for it, this thing works in two ways. So first is, if your initial homework is very good and say you are fully convinced about the merits of a company, the investment arguments in favor of the company are very strong. Valuation comfort is there, management comfort is there. Everything, see, it ticks all the boxes. Then right at the start of the investing or picking the stock, you can straight away go to 10-15% and then gradually scale it up. uh, Earlier, if you have not done this, it will take only, say, once on your part to do this exercise, and that then inhibition will be gone. So it's just like breaking the ceiling kind of thing. The other thing is what sometimes now I also have started to doing is pyramiding on the way up. So if a particular stock initially you have bought the many a times in the small cap or micro cap space, the picture is not often hazy and you are working with very limited amount of information. And so you start off with your, say, customary 5 or 10% position, and as a couple of quarters go by, the picture becomes more clearer, or say you interact with another investor who had got better insights into the company, or you attend the AGM and meet the management and develop confidence about the prospects of the company, you can scale it up. So this scaling up usually should be done when the stock is in a, say, sideways consolidation phase. So sideways, what is a sideways consolidation phase? So that is basically whenever a stock spends, say, around 2, 3, 4 months in a 20% kind of range, price range, for a long period of time. That is your time to get into this stock, and then try to build up the position from there. And the best thing to see here is, uh, ideal thing is to, you can keep on increasing your weightage on the way up, provided the total weightage does not go out of whack. So I've done this thing in a 2, 3 positions of mine. And uh, once you get the confidence in the management and in the business, and the results come through, and then the price goes in your favor, this thing becomes easy. So I think that's from my side. Abhishek will have a different view.
Yeah, so my view is, for most investors, I would always suggest that you don't go beyond, don't go with a large allocation, because most of the time what I found is that, if you're a retail investor, you don't really have a insight which is greater than that of the market, right? And market and stocks or businesses is something that can go wrong at any point in time. And uh, I mean, obviously, in hindsight, it'll look great. If you have a, say, a 10 bagger, and if you think that, okay, I put in 25% of my money, it would be a life changing experience. But the problem is that that will be known in hindsight, right? What happens if you put in 25% and that stock, starts tanking 50%? Now the problem is that then you have to have the mental fortitude to be able to get out when the stock starts doing badly. Because what happens typically, psychologically, is the moment you have a very large allocation, your mind will start playing tricks with you, right? And you will start, the endowment bias kind of things will start playing up, and you will feel that, नहीं, uh, इस बार खराब हुआ है, अगली बार ठीक हो जाएगा, next time things will be better, right? Next quarter earnings will come. And all this while the price starts keeping, maybe, sliding downwards, and then you get into a mess. So unless you're very very sure, unless you are very confident of yourself, and I've, seen this with Hitesh Bhai, that he does not have that mental challenge of not being able to get out, right? So he will be able to get out, but that is not true for a lot of people, right? It's not very easy for people to cut their losses, if they have a very large allocation. So I would not suggest that for everyone unless you are very very sure of what you're doing, right? So that is, no, I would say, uh, a 5% to 10% allocation per stock is a reasonable bet. If you are getting a good, if you have a 10% allocation and it does well, you will have good results. And with 10% allocation, what you need is, you pretty much need, say 10, 12 stocks in your portfolio. You don't have to sort of bet all or nothing on one or two stocks. So that would be what I would think of managing risk first. Rewards will follow. The next question is from Sagar. Question is, do you see a major change in how equities are taxed in India once the next government is formed? Some financial market experts are talking about bringing in a direct tax code by abolishing LTCG, STCG, etc., which implies a 30% tax on equities for most of us who fall in the highest tax bracket. Uh, I think there's no point in discussing about these kinds of hypothetical situations. Uh, I don't think tax consideration should be I mean, I don't think tax implications is a consideration for your investment. uh, you will not stop investing, or rather we will not stop investing because a tax is X percentage versus Y percentage. So these are conjectures that keep happening. I see this happening before every budget is passed, before every election. There's no point to this. Ultimately, it's like, the GST on cigarettes. People who smoke, they will pay it, and it's life. I mean, you pay the tax and you move on, right? There's nothing much you can do about it. Next question is from Ravi Mittal. What is your view on small
Abhishek,
fin? Yeah.
Abhishek, sorry. For the first question, can I just have a follow up
No,
on the
please
first
write it on the
question that
chat.
asked?
Then we'll because otherwise it will become very difficult to manage. Write it on the chat. We'll come to it later.
Sure.
Okay. So next question is, what is your view on small finance banks? Hitesh bhai, you have any view?
Yeah, some of the I think I've written on value picker also that I find some merits in all these financial
So
smaller
Hitesh bhai, one
financial
second.
institutions.
Let me just give me 1 second. I think I'll have to mute everyone.
One guy needs to be.
Check. Mute all. Yes. Yeah. So Hitesh bhai, you need to unmute yourself.
Okay, now can
Yeah.
you hear me?
Yeah. Yeah. Go on.
Yeah. So, see, in that multi-bagger mindset, we talked about multi-year breakout as one of the mental models. So, in addition to that, what I would like to add is multi-year breakouts with the company quoting at relatively cheap valuations. So, even if you are getting a stock at a 3 to 5 year high or that kind of situation on the charts, and still the conventional parameters valuation remain cheap, then I think the results are going to be even better as per my experience till date. So some of the financials as on date seem to be falling into that bracket as of now. I will not go into the names of the companies, but I think some of the smaller PSU banks, some of the housing finance companies, some of the smaller microfinance companies, all these kind of companies do fall into that kind of a bracket. And I think if you choose your stocks wisely, probability of making money is pretty high. So that is about the small finance bank also fall into the same bracket.
Right. Okay. So next question is from Subir. How are railways, chemicals, and pharma sector still looking, say now, and in a 6 to 12 month horizon? So Hitesh
Should I
bhai,
answer that?
yeah, yeah. All tough questions for you. Easy questions for me.
So railways, I think, have had a very strong run up till now. Um, there could be a pause in some of the railway names, but it is very difficult to generalize the whole basket. I think there will be some stocks which will continue to run up in relation to the results that they post or the orders that they get, and others will take a pause, that kind of a thing. Pharma, again, it's a pretty big basket. Pharma, what I can see is some of the bulk drug manufacturers slash API players charts are breaking out. So there, I think the valuation as of now does appear expensive, but this is after maybe 3, 4, 5 quarters of continuously poor results because of excessive dumping of Chinese stuff into our market. And now I think things are attaining a bit of equilibrium in that space. And maybe that is the reason why these stocks are giving some kind of indication that they are coming out of their consolidation. Uh, Pharma, which was the third sector?
Chemicals.
Chemicals. Oh, so chemicals again the same thing. Chemicals lost their fancy in 2021, and it's almost 3 years now. There's a lot of talk about chemicals making a comeback. I can see initial signs on the charts of some of the stocks breaking out and trying to move up. But as a sector, I do not see too much promise for that. But maybe we can get a tradable bounce where say stocks can go up 50 to 100% from here. But I don't see stocks going up 5 times, 10 times from here as it happened during the earlier bull run in the chemicals. but a catch-up kind of rally can happen. That is my feeling.
So, I mean, I'll quickly share my thoughts. Railways, I think we've last 6 months, most railway stocks have gone sideways. They've sort of digesting the huge up move that most of them had. Uh, I don't see major change in railways. It sort of will depend on if there's a change in the government of the or the current government gets voted in. If the current dispensation continues, then I think we will see a lot more focus back on railways. And if that happens, I think the railway stocks will again start doing well. But like Hitesh bhai said, the big move is done. Now, what you will get from here on is more of earnings growth kind of rises. Pharma, again, very diversified basket. You need to understand what each company is doing, what their pipelines are. I think there is some promise in companies which are exporting to the US. US is under severe drug shortage. I keep sort of writing or tweeting about it. So there will be, and there is pressure in terms of making uh, drugs more cheaper and accessible globally. So I think Indian pharma as a sector is going to do well. It's been consolidating and has done well lately, but I think it will continue again. Uh, Stuff that will stocks that will do well has, you have to have individual views on that. Chemicals, I have a slightly contrary opinion from Hitesh bhai. I think, and I've been telling him that also. uh, I think sector has pretty much bottomed out. We are beginning to see the first moves of in terms of fundamentals, where numbers are starting to come. We're seeing export data, we're seeing sales creeping up. So most of the channel stuffing, the inventory stuffing that had happened over the last 2 3 years is probably behind. And again, you have to be very very stock specific, because chemicals, although it's a very large pool of stocks, so there are stocks which are very very different from one another. So you need to be very sure of what you are buying into. But definitely there seems to be promise from chemicals. But yes, if I look at it from a long term perspective, will you get a 5x 10x in the next 3 years? Unlikely. I mean, the big boom time of chemicals that happened in that 2013-14 period to 18-19, that is probably a thing of the past. Again, here you will get some catch up and some earnings growth kind of returns. Okay, next question is from SH. I don't know what that stands for. Which sectors would do well assuming current government comes back? I think uh, here you don't have to sort of think about. I think it's pretty much well described in the BJP manifesto, as well as I think a lot of discussion in most places. There's going to be a lot of focus on infrastructure. There is going to be focus on railways, in building airports, in building up digital infrastructure. So I think pretty much what has been the focus till now, building up manufacturing. So whatever has been the focus for the last 5 to 6 years will continue. I think that's what is there. Hitesh bhai, anything else that I missed in this one?
I think the broad sectors will remain the same. Uh, that will be, I think, infrastructure should be looked at.
Right.
Um,
Correct.
and the others are pretty much the same, railways and all this PSU basket also. But there will be sectoral churns within the
Right.
market also, and that will continue going ahead. So some point of time, some sector will take center stage and the others will take a back seat. Those things will keep happening. Uh, that is difficult to predict as of now.
So the next question is from Nutan, saying, "I'm a HitPick subscriber. Should we sell some positions closer to the result date?" I think a pretty easy answer to that is just wait for communication from the team, and as and when we get something, please act on it. Next question is from Sumit. How do we rebalance the portfolio for the stocks which have run up very high? Do you take the profit or leave it as it is? Uh, It depends. I mean, you don't unless you're feeling very uncomfortable with a particular stock, you don't need to do much. That is what I would say. Uh, if you're feeling very uncomfortable with a few stocks, maybe you can pare down a little bit and bring it down a few percentage points in terms of allocation. Uh,
My view would be, I think, to keep riding a stock that's going up, because
exactly.
it's very lucky for on your part and skill also on your part that you're latched on to a winner. So why not make the most of it? It's not as if you are going to have 10 winners out of 10. So if one or two of them start running up, be patient with them and try to basically see. What I do is I tend to follow two important moving averages. This is because I want things out of my hands. So the first is near term up moves will be signified by 10-week moving average. That is the first port of call in any correction. Stocks that are not breaking below 10-week moving average, you should consider them to be very, very strong during corrections. And if they do breach this level convincingly, then the next port of call is 30-week moving average. If the stock does not stop at 30-week moving average and goes below it in a very, very convincing manner, then you should get out. Otherwise, what usually happens is stocks that take support at 10-week moving average are highly likely to reconquer that all-time highs and go into new territory again. Whereas the stocks that have gone down to 30-week moving average probably will go into a slightly longer consolidation of say around 2 to 6 months, and then again attempt short at all-time highs.
Right. So yeah, I mean, just to add to what Hitesh Bhai said, I think it's very important to be able to ride your winners. What I see is, I've seen this with him. I've seen it with myself. Our the big money that we've made is always when we've been able to ride our winners, even though allocations have gone up, right? I mean, for him, it's been sometimes allocations are way up. So for me also, I mean, it's sometimes some allocations have gone up beyond my comfort zone, but I've still held on because getting winners and being able to sit with winners is not easy. I mean, you will not get a five bagger or a 10 bagger very easily. So it's not easy to you should not let it go just because some event is coming or something is happening, unless there's some real reason for taking off the money. Okay, so
I
next.
see a lot of retail investors. I think I'll consider them to be newbies in some WhatsApp group. They have this tendency. Once the stock doubles, they sell half the position. मेरा stock free में हो गया. So that's not the way to go about it, because it can go up another 3 times from there also. Then where's the logic in making your stock free? So if you want to create real wealth, you have to learn to ride your winners. That is the only way.
Yeah, and I mean, a very good point. Just to elaborate or to add to that, ये free वाला जो concept है ना, this is fundamentally flawed, right? So there's nothing which is free. You've bought a stock at 100, today it is at 200. It's you are playing psychological games with yourself. If you're saying that I'll sell half and my holding is going to be free, that it's not the case. You're selling half. You're selling half of the opportunity also, right? Whatever is the money that you have mark to market, that is the portfolio today, right? You consider every day is a decision about the stocks that you hold. If you're holding a stock, it's a buy decision every morning or every end of day. So think of it in those terms. Okay. So I think we've spent a lot of time on one question. There are a lot of questions, and I don't want to
Yeah.
miss others. So we'll quickly go through them. Next question is from Alok. Specialty chemical is already costly as per your slide. So going forward, what's in store? I don't think it is costly. It's optically P would look costly because a lot of those stocks have not corrected a lot, but the earnings have not gone up. Once typically in cyclical sectors, this is a very typical thing that happens. Once the earnings start going up, you will see that the P's will normalize. So, in my opinion, I think the earnings pickup will happen sometime in the next maybe 2 3 quarters. Next question is from Amit. Assuming a large enough portfolio, in what percentage can I divide among quiver, hit picks, Q10, Q? Okay, I have high risk appetite and long term horizon. So this is a question that I cannot answer. Neither can Hitesh Bhai, nor can anyone else. This is a question that you have to answer yourself. Depending, there's no prescription, right? I mean, these are all distinct strategies. You have to figure out for yourself, what you are more comfortable with, and then decide, right? I mean, there's honestly something that I or anyone else can help you with. Next question is from Sachin. Can some tailored advice be given in terms of doing portfolio review for your HNI customers? I've thought about it. See, my concern or my thing is, uh, I don't want to run a very large team, and doing portfolio reviews, etc., is a manual effort, which I personally don't enjoy doing. I'm sure Hitesh Bhai or people who are in our team right now would also not enjoy doing. Our enjoyment comes from looking at businesses, looking at charts, looking at quant data, uh, and sort of trying to get better investment ideas for ourselves and for you. I don't think doing portfolio reviews is something that one we will enjoy and is also going to be a worthwhile effort, considering the time and effort that needs to be put in. That's my personal take. The next question is from Dr. Manoj. For a corpus of about rupees 1 crore, which will be better, Sri Rama PMS or Quiver, keeping in mind frame 5 years for wealth creation. Again, not something that I can comment on, but it will again depend on whether you want to do the execution yourself, or you want to sort of hand over the execution to the PMS. So it's again your call, not something that I can talk about. There are pros and cons of both. Ultimately, you need to take a choice, decide based on what you are more comfortable with. Some people are more comfortable, handing over the money and being headache free, doing what they want. Some people are, they want to do the execution themselves. So it's essentially up to you. The next question is Amit Suresh Kinikar. I hope I'm pronouncing it correctly. What tools and parameters to be used to identify sector rotation? Could you please share the process? Hitesh bhai, you go first, then I'll go. Sector rotation process.
Sector rotation, basically, see, it's more a visual thing where you start finding multiple stocks from the same sector making a 52-week high or 2 year high, 3 year high, kind of multi year highs. And then you try to look into the reason for that kind of run up. So if everything fits in together and say around out of say 20 sectoral stocks, 7 or 8 of them are showing bullish signals, then probably you can say that that is the sector that is showing some promise.
Yeah, so just to add, I think, see, there are two ways of looking at sector rotation. One is fundamental, one is more, technical based. You can look at just how sectors are performing. You look at stocks, or individual stocks are performing, and you can get a sense of what is happening. Uh, Also, you can look at the quarterly results of sectors, and especially this is I'm talking about when I'm talking about quarterlies. I'm talking about long term stocks. You will see that some sectors start throwing up better numbers over a period of time, and then once you have that Lollapalooza of better numbers coming through, along with better price action, you have a winner in your hand. So uh, there's no easy or parameterized way of figuring out sector rotation. But broadly, you have to look at both fundamental results of companies that they are throwing up and what the price action tells you. Next question is from Pranav. What should be the maximum allocation in one stock in case of pyramiding up from risk management perspective in portfolio? Again, this is a question that has no definite answer. It will depend on a lot of factors. It could depend on your portfolio size. It could depend on your stage of life. It could depend on the kind of stock you're invested in. It could depend upon the liquidity criteria that you have on so many things. So, for example, just as an example, in the last month, we all saw, SEBI coming out with a guidance for mutual funds to share their, how liquid those funds were and how quickly they can sort of liquidate their portfolio, right? And so this was not in anybody's radar, but suddenly this has come to the radar of, say, mutual funds, etc. So most funds do have a written down policy where they have this idea of, okay, we should be able to say, sell off our portfolio within a month or 2 months or 15 days, whatever the case may be. So there is no hard and fast rule uh, that as an individual investor, and I think that is an opportunity as well, because unlike institutions, unlike mutual funds especially, or insurance companies, uh, you don't have to have a fixed boundary. So, for example, a lot of mutual funds will have a boundary of, say, maximum of 5% per stock or 10% per sector, or a deviation of, say, 5% from sectoral weightage in an index. So those are things that as an individual investor, or in a advisory service, or in a PMS, we don't have those constraints. So that's something I think is an advantage for us as individual investors. So in short, there's no easy answer to that. Broadly, I would say 5 to 20% is what you should look at as a maximum allocation in one stock. Hitesh Bhai would probably disagree. He would, for him, I don't know, maybe 50% would be a maximum. But in general, I would say uh, maybe stretching it a bit, maybe 20-25% is what I should say would be the maximum for a stock while you're pyramiding up. Beyond that, it tends to get more risky. Even at 20-25%, it is risky. It's not that it is not risky. You have to be very, very sure of what you are getting into. But again, just to reiterate, it is not something that it's not a number that you should take up lightly. You should consider multiple aspects and then only decide, you know, uh, the maximum allocation. Because see, the what happens is, in good times, you'll feel very happy, right? When your stock is doing well and everything is fine, you'll feel very happy. The problem starts when the tide turns, and the entire I in fact, today afternoon, I was sitting with a gentleman who was telling me that, and he's been in the markets since the 80s. And he was telling me that he had made so much money in that 84 to 89 period in fertilizer stocks, etc. And then he gave back everything and more, because he was doing badla, he was over leveraged and all that sort. So the point is that when the tide turns, you want to be solvent. You want to retain your gains. You want to ensure that you are there in the market, right? You don't want to get out of the market, and because you don't want to be taken out of the market. So I think that is very important. If you're there, if you're even if your allocation is a bit less, what is the worst that will happen? You'll earn a little bit less, but you will be there over the next 10, 15, 20 years. You will make enough money. Like Munger said, at the end, it doesn't really matter if you end up with 100 rupees versus 102 or 105. I mean, it's all beyond the point. It's just a number. Okay, Sumit, next question. Do you think there is a major tailwind in infra and manufacture sector if Modi comes back to form the government? I think we already discussed this. The answer is obvious, yes. Next question is Anand. If one is sitting on decent profits on existing positions, it is wise to book profits and sit on cash in view of elections. My concern is with 370, 400, etc. targets thrown around loosely, will market react negatively if BJP ends up winning less than that, even if they form the next government? I think Hitesh Bhai covered this precise point in the presentation. Uh, Again, very difficult to say what is going to happen, how the markets will react. Uh, you can have some cash uh, with you, but again, it's up to you in terms of how comfortable you are with your current holdings. Personally, I'll tell you my personal thing. I will probably be slightly lightweight, maybe 10-20% cash in my trading kind of positions where we have short term bets, and in the long term bets, I don't think we'll make any changes. I don't think uh, whichever government comes, whether the current dispensation wins 300, 350, 280, whatever, 250, I don't think it's going to make a material difference beyond the first 2-3 months. That's my personal view. I could be wrong. Hitesh bhai, I'm just taking each question. Wherever you think you want to add something, just
Yeah.
get in. Aniket, next question. How should I expand my investment in a particular stock once it has increased by 100, 150%? Just add. I mean, there's it's the price is all in your mind. If it is 100, see, I buy a stock at 100. I have had cases where I've bought. I'll give you a classic example from my own book. I bought say Supreme Industries when it was, I think, 20, 24, 25 rupees. I kept buying till it was 200. So if I consider, say, 20 to 200 is a 10 bagger, and I still kept on buying, and I sold at 1000, 1100. So if you think that the stock is going to go up and it has a long runway, doesn't matter whether it has gone up 100% in the past. How does it matter at all? Hitesh bhai, your thoughts?
Yeah, basically, this percentage gains is something you don't consider while riding a company. You check how the company is doing in terms of its fundamentals, how the price action is doing, and during, as I said before, also during sideways moves is the best time to add, if at all you want to add.
Right.
Don't add during spiky up moves. That's where most investors tend to falter, that breakout aa gaya, let me get into it. No, if you are scaling up your position gradually, then it should be during times of sideways
Consolidation.
consolidation, or whenever it is very close to support zones.
Right. Absolutely. Okay, next question is from Geeta. Thank you for this webinar. Regarding the IntelSense long-term picks, would you say that it follows the buy at any price philosophy, or is the valuation evaluated at regular intervals, asking for the stocks where current price may be way higher than the recommended price? Okay, very good question. I think, see, the challenge in any, kind of a advisory research kind of service is uh, there are people who are coming in at all points in time, and let's say I like a stock today, and today it is priced at 100, and I think that that stock has the potential of going to 500, and so from 100 it has gone to 150. Now what do? I mean, do I say that, okay, since it has gone up to 150, I will change it from buy to hold status? I don't do that. So what I typically follow is I'll either have a buy, unless it has gone really out of whack in terms of valuations. I'll not put a hold, and then I keep evaluating performance, and I keep evaluating the I mean, the entire team, we do this. We look at the valuations, and then we keep changing if we see that the future prospects are not as promising as something else which is sitting out as the 12th man. We'll try to bring that into the team. So that's how we try to structure the portfolio, and that's how I personally invest in my own portfolio as well. So for example, I have my current portfolio today. If I get some money, I will add to my existing bets, irrespective of the fact that I might have bought a particular stock maybe at half the price of where it is today. And tomorrow, if I find a better idea, I'm equally happy to sell in one go and then put all the money in the next one. So, and what I've seen is over a 2 year, 3 year period, the performance of uh, this kind of thing actually evens out over time. So it's not that big a deal. It's more a psychological thing in terms of, okay, this stock was recommended at 100, today it is at 150, 200, or maybe 500. So I'll give you an example. So Elicon, I think we recommended at around 140, 140, 44, I think. Today I don't know what the price is, maybe 7, 800 rupees. Uh, and all the while it was going up, I kept getting these mails or questions that 144, 300 ho gaya, should we buy? 500 ho gaya, should we buy? The point is that, okay, I mean, if the stock has runway to grow, you can buy and hold. I mean, yeah, the guy who bought it at 144 will have a better result uh, than if, somebody else who bought at say 300. But obviously, the person is also invested earlier, so the time factor also comes in. So I think over, if you're planning to hold for the next 5 years, 10 years, these things will even out. It's not that big a deal. Okay, so the next question is from Urmil. How do you deal with stocks which get extended but still has a lot of tailwinds? For example, renewables, transformers. I have been early in these, sitting on decent gains. Everything I think of reducing position, I tell myself to build mental muscle to ride the trend, but I'm not able to put this thought to rest. So I think we already discussed this. Hitesh Bhai mentioned that you should not jump to book profits. If you're lucky to get into good trades, good stocks, good investments, try to sort of maximize it. Uh, the only addition that I would make to that is have a well defined exit criteria that you define for yourself. Say that, okay, I will get out if say 1 or 2 consecutive quarters of poor results come, or I will get out if say the stock falls below say 200-day moving averages, something like that. I mean, have a criteria where you are not holding on in hope, right? Have a predetermined criteria for getting out. Next is Nikhil. Hitesh bhai, recently in your value picker, you disclosed the position in IDFC first. Stock was below 30-week EMA. Generally, for technical investors, 30-week EMA is considered sacrosanct, below which they are not looking at the stock. What is your thought process in this? And should we be looking at stocks below 30-week and based on specific setups?
So I think I'll take that one.
Yeah, yeah.
So in that particular post, I had specifically mentioned about the exhaustion gap theory. So at the fag end of a bear market in a particular stock, if you get a gap down, and if that is covered within a very short period of time, maybe within 1 or 2 or 3 trading sessions, then you should treat that as an exhaustion gap, and it usually signifies that the selling is done. So then either the stock goes sideways or then it starts its journey up. So that was the logic in getting into IDFC First Bank. Plus, I had put up the retracement levels also. All during the recent correction weakness in the market, the stock price did not go below the 50% retracement of the previous rally. So that also signified strength. So there are 2, 3 vantage points from where the stock price looked attractive for a medium term position. And then I had also described about the flag like or that kind of uh, formation and with clear cut targets of say around 110 to 115 which were possible. So those are the basically setup that was visible at that point of time, which induced me to take position. And another very, very important thing for me was the amount of liquidity that the stock offered. It trades millions of shares per day, so getting in and out is not a big problem. So in those kind of stocks, I can afford to take slightly larger bets also. even if it remains a techno funda pick.
Okay, Hitesh, my next question is also for you.
Yeah.
Follow up with a question on pyramid. Does pyramiding on price rise make sense or basis result, as generally stocks react prior to result these days? Question two is how to protect downside risk of portfolio in larger bets.
So pyramiding up, ideally, it should be a combination of technicals and fundamentals. So these days, what happens is results. Some folks do know about the results beforehand, or manage to guess the results based on data, export data, and that kind of thing. So there is often a run up prior to the results, but after. But if there is a run up prior to the result, then there is a pause after the results, or it's the other way around. And any sideways movement in the stock for say a few days or a few weeks is the time to build up your position even at a higher level if you are convinced about the story. Because see, one of the things Peter Lynch mentioned in his book is sometimes the best bet is the stock that you already hold. And believe me, that holds true in a lot of our own picks also. So it, it often makes sense to pyramid on the way up in your own picks also. But you have to be very sure. And regarding the next part of the question, how to protect downside risk of portfolio in larger bets. So you first determine how much you want to take that position to. Everybody will have different filters. Some people will stop it at 20%, 25%, 30%. So that is one part of the equation. The other part of the equation is how much of a drawdown you can take in that particular stock. So usually a stock that corrects 20 to 25% from its recent swing high, you should consider it as a routine correction. Anything more than 30-35%, and you have to trim down your positions at least, if not get totally out. So if you are having large bets, then you need to have discipline also to protect your the gains or losses because of that particular position. So you have to have some kind of benchmark related to your exit, as Abhishek mentioned. That exit rules, even if they are soft exit rules, also you have to have them. Then only you will be able to ride these large bets.
Okay. Next question is from Geeta. How do you view the tech sector in the near future and say in 6 to 12 months? And the following question, I think, is on similar note, is
Yeah.
from Anand. Abhishek, what to do with large cap IT service companies allocation if one has? I was expecting some positive commentary, but looks like the pain is going to last for much longer. I think, see, the problem with IT services is that there is pain in the global economy. Europe is in not a good state. US is in not a good state. So spending is now, the client companies are not spending as much as needed for growth for these companies. So it's going to be a tough time for the next, I think, at least another 2-3 quarters. From a stock price perspective, my guess, and I could be completely wrong, is that we might be close to the bottom, or maybe we've already bottomed out. But even if you buy now, you might have to hold for 2-3 quarters for things to start looking better. That is what I would say from for the IT pack. The other thing is there within the IT pack, there are a lot of companies which are not core services. So the ER&D companies, those have a different uh, kind of risk reward. They have a different business dynamic. So they don't behave like what the normal IT services companies are doing. And you have to take a look at them separately. I think some of them are continuing to do well in terms of business performance, even while the last 1-2 years when IT services not done well. So I think there is some amount of stock price pain still there. Fundamentally, I think we could be uh, you know probably close to the bottom. I think things can probably start looking better. Next question is from Kiran. Thanks for the wonderful growth of the portfolio. Now that the portfolio size is increased, how should one go about allocation of a new stock? At what time interval should one change the allocation size as per increase in the portfolio value? I Okay, very easy question to answer. Do it very infrequently. Do it maybe once a year, beginning of the year, beginning of the calendar year, on your birthday, whichever you feel like, and say that, okay, today this is my port. So let's say you started with 100 rupees, 20 stocks, 5% allocation, 5 rupees each. Now let's say your portfolio is 200 rupees, and one fine morning you decide that, okay, today I will benchmark my portfolio at 200 rupees. So then you sort of do a rebalance if you want. So, there's no hard and fast rules about these things. These are, basic, sort of heuristics, rules of thumbs that you can use to manage things better. Next question is from Harshal. How do you think is the execution going on for Kavach? Recently, player other than HPL, Karnex gave very optimistic numbers in the last presentation. Any insights would be useful. I think Kavach rollout is continuing. It's a very long drawn process. Indian Railways implementation is very, very large. It's going to take more than 10 years for Kavach to get implemented. I think it's much more than 10 years. Even though, if even if we have more players coming, so it's going to happen. I mean, this is not something which is optional. It's going to be there. It's going to be mandatory. The rollout is going to happen over time. So I think numbers, the tenders will keep coming, and it will keep getting implemented over time. Next question is from Rahil. Any view on companies into data center transmission, though run up has been sharp? I don't know what data center transmission means. Maybe Rahil, I don't know if Hitesh bhai, you know what it means, but
There's no
Rahil, you
sector
can.
related to that, but you can loosely consider certain companies that cater to data centers.
Data center or transmission, I don't know whether he's talking about cables and all that. Maybe if that is the case.
Yeah, Abhishek. Basically, Abhishek, the question is more around the theme emerging in terms of power as a sector, or companies which are catering to that sector. So Anantraj, Techno Electric, or maybe companies which are catering to the
Okay,
power
got it,
sector
got it,
as a
got it.
long
So
term.
see, simple question, simple answer to that is you need to understand who are specific to data centers, right? Who are the players? What is the revenue mix of a data center, right? Who's going to make the most money? So if look at say a Anantraj or a Techno Electric, what is the share of the pie of a data center? They are people who are so Anantraj, and a lot of people are just doing the construction, doing the electrical wiring. How much is that as a percentage? Roughly between 6 to I think 14% or 15%. The biggest money is in the server racks and the components, which we don't have a direct play in India. The other component is the HVAC systems, which is your Blue Star, your Voltas, your Hitachi, and those kinds of companies. Then you have the wire makers, right? So that is, and then you have players who are providing gen sets and batteries and etc. So across the themes, you'll have players. You have to figure out where you want to bet, uh, and then play it accordingly. So I think data centers obviously is going to grow. There's no two ways about it. Uh, how you want to play it is up to you. I think we have a couple of plays in our long term portfolio which cater to this theme, and they've been doing well. I think they will continue to do well for a fairly long period of time. Next question is from Pinak. It seems to me that the time frames for a lot of small and mid caps have become condensed. Corrections are very sharp and swift, and up moves are parabolical. In such a situation, it's very tempting to sell stocks when we have high conviction, when they are going sideways for months, with the hope that we can catch the next up move if we keep following them. Have you succeeded with timing buys and sells in the same stock, or does it make sense to stay put in high conviction stocks? There's by your question, then
Yeah.
I'll take.
So the after a lot of attempts at doing all these kind of stuff, I think the short answer is it makes sense to stay put in high conviction stocks. So maybe you can get your timing right in 2 out of 10 stocks, but that doesn't make for a high enough percentage to take that path. So at the most, what you can do is you can trim your positions during very sharp rallies and keep riding the rest of it. That's what I have been doing of late, because some of the stocks have run up like a lot in last 1.5 years, and the allocation part also comes into play. That if the allocation goes beyond a certain point, then also it makes sense to trim it. So taking all these things together, trimming the position slightly and staying put in the rest of the position does help.
So yeah, I mean, exactly the same answer for me. I think it's very uh, it is very difficult to get in, get out. What I do is, I don't know how many. I mean, again, I'm speaking of probably my age. People who are younger may not know this, but when we used to have those stereo systems, we used to have these graphic equalizers. So you basically go up and down based on the particular frequency. So I pretty much do the same. So when I'll reduce allocation for something, then I'll increase allocation for something else, and that's how you calibrate basically. But I don't want to get out completely in a high conviction bet, hoping to get back in. It's very difficult psychologically to do it. uh, I've made this mistake in the past, and I've not been able to get back. I can't see Hitesh Bhai's face whether he's laughing at me, because he knows this case where I was getting tired of holding on, and I got out, and I knew when to get back in, and but I could never get back in because I was invested somewhere else and things like that. So these kinds of things will happen, and it's better when you know for sure, or not for sure, but when you know that something is there for that's going to make you money over the next 12 months, 24 months, 3 years, 4 years, then it's better not to try to be too smart, I think.
And the other thing is, what happens is, once you move out of a big position, for say people like us who have got 4 or 5 ideas on the standby mode, the money inevitably goes into those ideas. And when the time comes to re-enter that position, you are already invested somewhere else.
Correct. that
So,
is that is a
in the
big challenge.
highest conviction bet, don't make a total exit. At least remain partially invested.
Next question is from Shashank. What tools do you use for charts scanning? Uh, as you mentioned that you used to share charts earlier. Can you start that again? I had asked this question earlier, and you had mentioned that you may explore publishing charts in your blog. Yeah, I mean, yeah, I will do that. I know. I'm fundamentally slightly lazy. Uh, so I'll do that definitely. The problem is, see, what happens is, if I publish charts, a lot of people start thinking of that as recommendations, and I don't really want that. I don't want people to feel that you buy something, then they get trapped if something goes wrong, and that's not something which sits well with me. It's I can I can publish charts. I mean, I look at charts a lot. I do a lot of quant based analysis, etc. So putting up stuff is not very difficult, right? But I don't want people to get misled by what I'm putting up. So that is one concern that I personally have. But yeah, I mean, definitely we'll do that. I think Hitesh Bhai keeps doing that on Value Picker. I'll definitely try and do that. In terms of questions on the tools that you use, I'll tell you mine. I use TradingView, I use Charting, I use Screener, I use Tijori, I use Trendline. So uh, and I use obviously my own Python scripts for our own analysis for on the quant side. So that's what I use. I think Hitesh Bhai uses Screener and Metastock. I mean, after him to move away from Metastock, but old people don't change. Okay, so next question is from Geeta. Just like max allocation, is there a minimum allocation you recommend for a stock in the portfolio? I personally would say don't go below 3%. Uh, Ideally, 5% should be the minimum. That starter position 3 to 5% is the minimum. that one should take. Below that makes no sense. Hitesh bhai, your take?
Yeah, I think 5% should be the bare minimum.
Okay. Sandeep, question from Sandeep. Do you consider relative strength of the stock under study with respect to index while considering entering a new stock or holding on to an existing stock? I don't. Hitesh bhai, do you look at relative strength?
No.
Right. I don't think I do. Okay, let me rephrase that. I mean, we don't probably use it explicitly, like we don't have it on our charts, etc. But I think intuitively, because we know the stocks that we are following, we pretty much know how well it is doing with respect to an index, right? So
Yeah,
maybe
so we have got a fair idea whether it's
exactly,
outperforming the market or not.
exactly. So we probably have an idea, but I don't think we explicitly use it. But maybe implicitly somewhere there, it's at the back of the mind. But I don't think we use it explicitly. Uh, So next question is from Aman. Hello, Hitesh sir. For hit picks recommendations, while recommending which moving average you look at to recommend stop loss, I'll take that question. We don't have a moving average that we use as a stop loss. Most of the time, it is chart based for hit picks, uh, and quite a number of times there are multiple factors which come into putting the stop loss. It's not as simple as putting one single moving average. The next question is from S. Mulugu. I'm assuming that's a short name or handle. Any suggested books to understand investing in sectors, their usual P3 band, cyclicality, etc.? I think one book that comes to mind, which I recommend everybody read, especially when they're starting off their careers, is Morning Stars. I think Pat Dorsey's book. Forgot the name. Five whatever, pillars of
High rules for successful
ha
stock investing.
Five rules for successful investing. So the first part of the book, he talks about how to go about doing a DCF, etc. And the second part of the book, he talks about looking at individual sectors and the KPIs for each sector. So that book itself is a very very good primer for investors, whether you are new, old, whatever. So it gives you interesting insights into each into a lot of sectors. Next question is from Keshav. What's your view on the logistics sector with respect to major auto players also getting into the business like Mahindra Logistics, TVS Supply Chain? I don't think I have a view on any logistics players as such. Hitesh bhai, you have any view on logistics?
Going ahead, I think with the operationalization of this freight corridor and all these things, a lot of this, mm, what should I say, logistics park kind of companies will come into play. But I think that is still some time away. So it should be a sector that should definitely be studied. But as of now, no definite picks from that sector.
See, I mean, one thing that I think, logistics as a sector, I mean, obviously at a macro level, obviously it's going to grow. But it's a very competitive field, very low entry barriers, uh, very region specific as of now. Uh, it's not an easy business to make a lot of money in. So I think that's one of the challenges. The next question is from Amit Agarwal. I find challenges with selling. Any learnings with approaches? Yeah, so I actually intend to write a separate blog, and maybe I'll do a separate video on selling. I've already started collecting materials on it, so we'll do that. But Hitesh bhai, I think everybody has this problem, challenge with selling. Any short tips, or maybe we can cover it later at some point in
See,
time if you want more details.
if you, it depends upon the kind of approach you want to take. For a fundamental approach, say if at that point of time the stock price tends to price in next 2 or 3 years of valuations, then it makes sense to get out. And technically on the charts, what I have found is during the parabolic phase of a stock, as investors, we also tend to get paralyzed by the price moves. It's very difficult to let go of the stock. Say today I sell 5% and tomorrow I see that same stock going up 10%, 15%. It's difficult for me to sell more of the stock. So in that case, the simple moving averages that I follow is 2 times 200-day moving average usually is a good time to at least lighten up your positions. And in extreme cases, 2 times 30-week moving average. So 2 times 30-week is 150 days moving average, roughly. So these are the two parameters that have come in useful for me because the subjectivity on my part. It is a totally objective parameter where I can decide to sell, and it is not a sacrosanct number. So if 200-day moving average is at 100 rupees, then it doesn't mean that I have to set exactly at 200 rupees. It has to be in that particular range, say 195 to 205, that kind of a range. But it definitely helps in taking a clear cut decision without getting involved emotionally. I hope that helps.
Yeah. So, next question is from Sachin. When portfolio goes beyond a million USD, do you recommend moving some cash to gold, bonds, or AIF? I'll take this question and I'll answer it uh, exactly the same way that I heard the late Rakesh Jhunjhunwala answer this question when he was asked this question. Uh, it's basically up to you. I mean, a million US dollars can become 10 million, can become 100 million. Uh, it, it makes no difference. It's just a number, right? Uh, it, what you do, what is your overall asset allocation depends on your life stage, your risk appetite, what are your objectives. Uh, RJ said that he was always going to remain fully invested in equities. That's what he did for his life. For me, I mean, I'm invested nearly fully in equities. Hitesh bhai probably fully in equities. So, irrespective of the number, I think it's an individual call. Uh, there's no, uh, there's no, there's no rule as such. If you feel, uh, if you feel uneasy, you should talk to a financial planner, etc., depending on what your goals are, and then plan accordingly. Your asset allocation. We're very, very close to 9:30, so I'll take maybe one last question. Uh, okay, so can you please explain what is the process you use to determine time targets like 4 to 6 months in stock charts? This is for hit picks. Uh,
So
so
I'll take it. So
yeah, yeah,
basically, whenever we recommend a stock, it is based most commonly it is based on some kind of pattern that has formed in a fundamentally good company. So we take into consideration the pattern target most of the times. So now you can take it, Abhishek.
right. I think yeah. I mean, it's uh, there's no exact way of saying this is going to take this period of time. It's a pattern target. How long it can, how long would it usually take to play out. So it's a hunch, it's a gut feeling that I think we have in terms of what is the more probable time period that it will take. And we've seen sometimes and people who are who've been in the service would have known that sometimes the targets come much before what we've envisaged. Sometimes it takes longer. So it's a best case guesstimate when we start off with just the idea to tell ourselves that this is the time frame that we're looking at, and then that's what we start with.
And many a times what happens is the targets are exceeded and we still advise you to keep the position running because
Correct.
we see more upside. So it's a way of sort of running your, allowing your winners to run. So it's that kind of a thing. So we take things as they come. Initially, because we have to give targets, we do give targets. But oftentimes it happens that we feel that there's much more upside left, then we allow the stock to run. And we advise you accordingly also through the mail also.
Correct. So I think we've spent 1.5 hours Thanks Hitesh bhai, thanks all of you for joining, taking out this time on a weekday, evening, morning, afternoon, wherever else in the world you are. Thank you all for joining, and keep sending me your questions, uh, and we'll keep doing this, uh, hopefully more often. And thanks for being part of our lives. Thank you.
Thank you, Abhishek. Thank you, Hitesh bhai.